Indiana, a worker put on his coveralls and walked through the factory gates, same as always. He'd been there over 20 years. He paid into his pension with every paycheck. He was loyal and dependable. A few months later, Studebaker shut down. 4,000 workers walked out through those doors. And the future they thought they owned was already gone. Their loyalty hadn't protected them, not because they'd done anything wrong, but because they placed their futures inside someone else's ledger. My name is Toomey, and I've spent way too much time thinking about retirement, the math of money, and why people keep going long after they could stop. If you're past 59 still working and honestly not sure why, keep reading. Because what I'm about to tell you isn't a pep talk. It is a pattern, one you may be living right now, but nobody has ever named for you. And for certain people, that pattern is very, very profitable. When someone in their early 60s is still working full-time, people tend to react in one of two completely wrong ways. The first is performative praise, saying good for you, keeps you sharp, as if a 60-something staying on the job genuinely loves quarterly reviews, or actually enjoys sitting through those endless status update meetings. The second is quiet judgment, asking why you didn't plan better, as if everyone's life just magically runs on a perfect schedule, as if layoffs, divorce, medical bills, and inflation are just excuses, rather than terrible things that actually happen to real people. Both of these reactions miss the point entirely. Most people over 59 aren't still working because they love the job. They are there because they are constantly negotiating with fear. And fear is the absolute worst financial advisor in the world. To be fair, the anxiety isn't just coming from nowhere. The median retirement balance for Americans in their 50s is under $200,000. Roughly 4 in 10 working-age adults have no retirement account at all. So yes, the finish line is closer than they're willing to say out loud. But here is the strange part about this whole situation. Even people in solid financial shape overwhelmingly feel like they don't have enough. That is not a coincidence. It is actually a built-in design feature. Researchers asked wealthy households what it would take to feel financially secure. They got a remarkably consistent answer, roughly twice what they currently have. People with $5 million said they needed $10 million. People with $10 million said they needed $20 million. The finish line keeps moving because the finish line isn't a number. It is a feeling, and there is an entire industry built on keeping it alive. Here is a number that is really worth sitting with. If you're in your early 60s, you have roughly 1,000 healthy weeks left. Not total lifespan, I mean the time when your body still cooperates. When you don't have to calculate how far away the parking spot is. When your brain is still running at full speed at 2 in the afternoon. When a red-eye flight doesn't require 2 full days to recover from. 1,000 weeks sounds like a lot, right? Run the conversion. It is about 20-some summers and Christmas mornings. A very limited number of hikes your knees will actually forgive. And then comes the truly brutal part of the equation. You cannot buy any of this back later. Not a single week. You might be saying that you don't have a choice. You have to work. Sometimes that is true. Some people genuinely need the income to cover basic expenses. If that is your situation, I am definitely not here to judge you. I'm here to make sure you're not getting taken advantage of in the process. But a lot of the time, the real issue isn't the math. It is uncertainty. It is the complete and total absence of clarity. It is a feeling that if one bad thing happens, everything just falls apart. Even when the actual numbers don't support that fear at all. And that feeling is enormously useful to certain people. So I need to challenge an assumption that almost nobody ever questions. People widely believe that working one more year is always the safe move. Sometimes it is. More accumulation and market recovery are real benefits. But sometimes working one more year just becomes a trap because it can substitute for an actual plan, avoiding a real decision. it can just let fear run the show for another entire year. And the most dangerous part is what you are trading away. It might not be an ordinary year. It might be your last healthy one. The truth about retirement is there are two completely different circumstances, and from the outside, they look almost exactly the same. Situation 1, you genuinely don't have enough money. Situation 2, you have enough money, but it doesn't feel that way. These sound similar, but the solutions are completely different. The first requires an income plan. The second requires a psychological framework. Most people who think they're in situation 1 are actually in situation 2. This matters because solving a psychological problem by just working more fixes nothing. You are not fixing anything. You're just postponing the inevitable reckoning. Most people stare at their portfolio and ask if $500,000 is enough. I am here to tell you that is exactly the wrong question. The right questions are about your basic monthly expenses and guaranteed income, and figuring out exactly what the gap is between those two numbers. Let me break this down into 3 very simple numbers for you. Number 1, your monthly baseline expenses, not your ideal spending. Not the travel and shopping version. I mean the absolute floor. The minimum it costs to keep your life running with housing and food, along with your insurance and your basic healthcare costs. Number 2, your guaranteed income floor, including Social Security and pensions. Rental income you can count on, and fixed income independent of the market. Delaying Social Security past full retirement age increases your benefit by 8% yearly, up to age 70, if your health and cash flow allow it. That is a very significant lever you can pull. Number 3, your gap, which is baseline expenses minus guaranteed income. That gap is what your investment portfolio actually needs to cover. Say your monthly baseline is $5,000 and guaranteed income is $3,000. Your gap is $2,000 a month or $24,000 a year. To cover that gap at a 4% withdrawal rate, you need roughly $600,000 in a structured portfolio. If you already have that, you're not guessing anymore, you're calculating. That is where clarity comes from, not from having more money. True clarity comes from actually knowing your numbers. Now, let me tell you something most people never say out loud. If the market turns down early in retirement while making withdrawals, you get hit twice. Prices are falling and you're selling at the exact same time. It is called sequence of returns risk, and it is brutal. Say you have a $300,000 house with a half-sized mortgage. You feel solid, so you borrow $50,000 to renovate the kitchen. Then the economy takes a hit and home values drop 20%. The house is now worth $240,000. Your loan balance is $200,000, destroying your equity. Your daily life didn't change. You're still in the exact same house, but your financial reality is completely unrecognizable. Retirement without a buffer works the exact same way. Everything looks fine while the market climbs, then withdrawals begin. The market reverses, you're forced to sell at the bottom, and the spiral starts. The solution isn't to keep working. The solution is structure. Cover your first few years of spending gaps with cash and stable assets. This bridge bucket gives your equity portfolio time to recover without forcing you to sell at the absolute worst possible moment. Someone will say cash returns are too low and inflation will erode it. Yes, but cash isn't an investment. It is an insurance policy. You don't regret buying homeowners insurance when your house doesn't burn down. The cost is real because the consequences are simply unacceptable. The bridge bucket works in the exact same way, and there is an unexpected psychological payoff once that bridge exists. Your brain stops being afraid and stops worrying about average returns. The bridge bucket is what lets you take that first punch. It lets you take the hit and stay on your feet. Here is another number that nobody ever wants to run. 1% in fees sounds trivial. You probably spend more on lunch. But a 1% fee on a portfolio isn't a tip, it is a lifetime tax. On $500,000, 1% is $5,000 a year. Every year, not just when you buy, not just when you sell. Every single year, indefinitely, draining your accounts. More importantly, that money doesn't just disappear as a 1% loss. It is money that would have kept compounding over time. Over 20 years, the true cost isn't just a few $1,000s. It could be hundreds of thousands of dollars you are losing. This is exactly why financial institutions love long-term holders. The longer you stay, the larger the asset base they charge against. If your all-in fees exceed 1%, figure out where it is going. Let me say something nobody will ever tell you directly. If fear is keeping you working past 59, you aren't the only one benefiting. Your employer benefits because experienced employees generate more value than their salary reflects, especially once they have completely stopped negotiating aggressively. The tax system benefits because your wages are being taxed every single year. The financial industry benefits, charging fees against your ever-growing asset base. And then comes the most ironic data point of all. Most retirees die with the majority of their savings still completely intact, not because they were brilliant investors, but because they were afraid to spend. They underconsumed, overhoarded, and made preserving assets their central purpose. I want you to think very carefully about what that actually means. If you're working right now because you're afraid of running out of money, you're trading your best years for money you will never actually spend. That is not prudence. That is a tragedy. Now for the part that is the hardest to say. Why do some people keep going when they could easily stop? It is not entirely about the money. For a lot of men who have spent decades as the provider, the one whose value was legible and measurable to everyone around them, retirement can feel like becoming completely invisible overnight. Nobody says this out loud because it sounds weak, but it is real. Work gave you a role, a structure, a scoreboard where rules were clear. Retirement has no deadlines, no performance reviews, no manager praising you. That sudden void can feel exactly like a freefall. So people unconsciously reach for a financial excuse to avoid the deeper question, who am I when the job isn't defining me anymore? They say they can't retire yet, but they mean something else entirely. What they really mean is, I don't know who I am without this. I'm not a therapist, but I can tell you the pattern I've observed. People who retire with genuine peace of mind aren't just financially ready. They already know what they're doing tomorrow morning. They have planned their time, not just their money. You don't need a perfect vision, you just need a direction. You need to finally give yourself permission to stop. The world won't give you that permission because it benefits from your labor, so you have to give that permission to yourself. If you're past 59 and still working, memorize these three numbers. Number 1, your monthly baseline expenses, the floor, not the ideal. Number 2, your guaranteed income floor, what arrives regardless of the markets. Number 3, your gap, which is subtracting the second from the first. Know these three numbers, and you move from guessing to calculating. You move from emotional decisions to structural ones. Then you need to ask yourself honestly, which category am I in? Category 1, I genuinely need the income to cover basic expenses. Category 2, I can cover basic expenses, but I'm afraid of market risk. Category 3, I can cover expenses, but struggle with the psychological transition. Category 4, I'm working because I genuinely love it and it gives meaning. Only Category 4 doesn't need to change anything at all. Categories 1 through 3 need a plan to exit, not to keep enduring. And most people who believe they're Category 1 are actually 2 or 3. Category 2 is solved with risk architecture, Category 3 with identity design. Neither one requires sacrificing another 5 years of your life. Enough theory. Do one thing today and open your retirement account. Run a quick audit and look for 4 specific things. First, your total fees, including expense ratios, advisor fees, and administration fees. Add them up, and if you don't know them, that is the problem. If the all-in rate is above 1%, You're funding someone else's retirement. Second, your concentration risk. Are you unknowingly overloaded in a single sector? Or multiple funds that sound different but hold largely the same things? Diversification isn't owning many funds. It is those funds actually owning different things. Third, your cash buffer. How many months can you cover without selling shares? If the answer is weeks, you're exposed. If it is years, you have a cushion. Fourth, your tax structure. Will it generate a massive tax bill at the worst time? This is one of the very few variables you can actually control. After the audit, do one simple calculation for yourself. Take the amount you think you still need to accumulate, divide it by what you can actually save per year after living costs. If the answer is 1 year, you're close. If it is 5, ask an honest question. Will the finish line still be in the exact same place in 5 years? Or will you still feel unsafe because the psychological piece isn't addressed? Because if it isn't, that finish line will just keep moving. Let's go back to South Bend, 1963. Those workers weren't naive, they weren't reckless, and they weren't lazy. They simply believed a promise. Keep showing up, and the system takes care of you. And that promise completely broke. The modern version of that promise isn't a gold watch or a pension certificate. It is a feeling that as long as I keep working, I'll be safe. Just like the Studebaker story, security doesn't live in the promise. True, security only lives in the structure. If you haven't built your own structure, you're depending on someone else's incentives. And someone else's incentives were never designed to maximize your freedom. I want to leave you with a completely different picture. Most people imagine retirement as stepping off a ledge, a terrifying jump. But retirement isn't a cliff. It is a glide path. You can reduce your hours without stopping completely. You can consult, work part-time, or move into something lower pressure. You can build income streams that don't require you to sell your soul. Sometimes the goal isn't to stop working. The goal is to stop being trapped. If you're 61 and working because you genuinely love it, that is power. If you're working because fear and confusion have you locked in, that is a cage. The difference between power and a cage comes down to one single word, and that word is a plan. The workers at the Studebaker plant kept showing up because they believed the promise. The promise you're making to yourself might be just 2 more years. Just 2 more years, and I'll finally be safe. But ask yourself honestly, safe from what exactly? Safe from market volatility? Then build a bridge bucket, a healthcare coverage gap, get real quotes, and plan your income around them. Afraid of running out of money? Calculate your gap and know your numbers. Afraid of being bored? Design meaning. Don't just manage money. Regret is the final tax you will ever pay. If you could have retired at 62 but kept working for a cushion, and then your health changed at 65, you didn't just lose money. You lost the one thing that cannot be bought back, your time. I genuinely want you to win.